All right, well, thank you for having me back. I recall last year I was asked a question about the impact of the election, and I tried to sidestep it. Um, Unfortunately, I don't think I'll be able to do that very much this year. Obviously, changes politically are pretty central to the economic outlook, so I'll try to unpack a little bit of that while going through our forecast for the U.S. economy and of course the Maine economy. So I just need my presentation to start. So if I think back to sort of what I had talked about a year ago, we had laid out themes in terms of a gradual progress in economic activity, ongoing improvement in the labor market, gradual turn in inflation. I talked a little bit last year about we were very low in terms of oil prices last year, and our expectation that that should rebound. We got that fairly correct, and we've seen alongside that a very gradual normalization in monetary policy. I really hope my slides are up there so I can use some of them. But so we got, the general themes of the economic outlook were fairly correct, but we, got some other things I think fairly wrong. It wasn't a great year for pundits and soothsayers, especially in the political arena. If you think back to the summer, the big event globally was the UK vote on whether or not to remain in the European Union, and I think the consensus of expert opinion was that there would be, no change in, or that they would vote to stay in the EU. Of course, they voted to leave. And then, of course, the presidential election where, again, I think, if you watched that night, you saw even the New York Times still pretty late into the evening thinking the result would be a result different than what happened in terms of a victory for Donald Trump. Okay, great. So, well, where does that leave us? Well, in terms of sort of the themes, I mean, the one thing we've seen since the election is a pretty substantial change in financial markets. Equity markets especially quite buoyant about the election result, expecting some change or some pro-growth policy. We've also seen a turn in bond yields and in interest rates on the expectation that we may get some faster growth, some fiscal stimulus, and also potentially some higher inflation. That is a key interplay with sort of fiscal policy and monetary policy, and I'll talk a little bit more about what we expect to see from the Federal Reserve. But broadly, we don't expect to see any kind of major change in our financial outlook. We have, I think, a lot of the run-up in yields has happened in reaction to the election. We'll see a more gradual increase going forward. A real important element, though, and I'll keep coming back to this, is that we are at the stage in the economic recovery where we're no longer having much of a cyclical bounce in growth coming out of the recession, much job growth that's coming from reducing unemployment, because we're so far along already that now the structural headwinds in terms of growth in the labor force and underlying productivity become more important. So that's really a theme that is played out not just in the United States, but really globally, and something that I think we have seen some of the ramifications of that in the political arena. But if you look back at sort of what the expectation for trend growth was around the world a decade ago and what it is today, it's sort of universally come down across countries. Key reason for that, and I think something that Maine is very familiar with, is an aging population, and having baby boomers retire, leave the workforce, and replaced with a smaller cohort of younger people has put downward pressure on labor force growth. If you look at sort of Europe, there are several countries in which there is zero labor force growth, the same thing in Japan. What's somewhat less appreciated is that this is also a challenge for China. China, the thought had been it could grow at sort of the double-digit rate, and even their trend growth rate has come down quite significantly. And a lot of that has to do with they face a huge demographic headwind in terms of the one-child policy reducing birth rates and really leading to a much slower rate of labor force growth in their economy going forward. Now, they still have an expected faster rate of trend growth, in part because they continue to catch up. They're not an advanced economy. But, really the biggest change is really in that economy. Some other economies around the world, I think we have other challenges in terms of the amount of debt that has been accumulated over the last several years as global interest rates have come down. That will be a challenge, particularly over the next 4 years, as we start to see monetary policy normalized, especially in advanced economies. That tends to have ripple effects throughout the world. The other impact of that divergence, sort of in terms of global growth, and something that is compounded or exacerbated some of the challenge for the U.S. is that we've had a pretty strong U.S. dollar. This is obviously something that has come up again in the politics realm. I'll stay sort of out of that and just speak to the economics of it. But the rise in the U.S. dollar over the last few years partially is due to the fact that the American economy is just further along the road to economic recovery than many other economies around the world, and not just in emerging markets, especially in advanced economies. If you look to Europe, the unemployment rate in Europe just fell a little bit below 10%. It's 4.7% in the United States. Even in Canada, the unemployment rate is 7%. And some of that increase in the dollar, again, reflected what has happened in commodity markets, especially in oil markets. If you think about where the Canadian dollar was a few years ago, when oil was $100 a barrel, it was pretty close to parity with the U.S. dollar. Now it's around, you can buy 1.3 Canadian dollars for $1 U.S. So that has happened as the terms of trade has shifted more towards the U.S., which is an importer of commodities, and away from commodity exports. Going forward, we don't think we'll get much more appreciation from here, even as the Federal Reserve continues to normalize policy. The ECB met today, and they are leaving policy on hold sort of indefinitely, even continuing a quantitative easing program. But I think much of that has already been priced in. And elsewhere, in terms of this turn in commodity markets, that should be positive for the currencies of some other economies that have really been hit hard. Nonetheless, a high U.S. dollar, even at elevated levels, even as it comes down, poses a challenge to obviously exports and makes imports cheaper. So it shares some of the improvement in the domestic U.S. economy with the rest of the world. Of course, it also increases some of the political risks. We heard President-elect Trump mention the dollar and thought it was too high. That there was a reaction in financial markets to that. There remains to be seen as sort of limited things a president can do to change the value of a dollar, but there are other things in terms of tariffs and things I'll talk a little bit more about, or I'm sure I'll get asked about. But obviously, having an elevated dollar increases the risk that there is that policy response. So as I mentioned, I think the place where you've seen the biggest reaction is to the election is in financial markets. We've seen it in equity markets. We've also seen it in the bond market, and it's an important point that we've had this reaction in the bond market and in interest rates in anticipation of policy that hasn't occurred yet. And that creates in itself some risks for the economy. If you think about commercial real estate markets, we've seen, especially in major cities, big increases in prices, reductions in capitalization rates, very limited spreads over treasuries. And as you push up the risk-free rate, that puts downward pressure potentially on CRE markets, especially in places where they're most elevated. Obviously, it raises mortgage rates, and you have the potential for a little bit slower housing recovery, given we've had about 100 basis point increase in mortgage rates. Now, having said that, I think the market can absorb it, and in fact, we're just back to, we had interest rates declining through mid-year last year. That reflected some of the uncertainty globally. As some of that diminished, you saw rates turn higher even before the election, and we're now sort of back where we were late last year. In fact, the election and the turn higher in interest rates saved saved our forecast for long-term interest rates, because we had been expecting them to turn higher. Through mid-year, it looked like they were going in the opposite direction, and it was only sort of very late in the year after the election that we saw rates return to where we had, probably where I had been talking about them being last year at this time. So going forward, I think, again, as I mentioned, we've had a lot of the reaction in financial markets, in bond markets. We've seen a little bit of a turn down in yields, and I think some of that is sort of a reevaluation of some of the fiscal policy we actually will get, and of course I'll talk a little bit more about that, but I think we will see sort of from here a gradual move higher. So our year-end target, if you're interested in the 10-year Treasury, is 2.65%. It's at 2.5% now, so a little bit higher, and then getting to 3% by the end of 2018. That will obviously show up in mortgage rates. So over the next 2 years, assuming continued economic growth, we'll have about a 50 basis point higher long-term rate. Now, as I mentioned, some of that turn in yields also reflected the turn in inflation. Oh, wow. I can look at my presentation over there. That's great. I just have to stand over here a little bit. Anyway, so yeah, I mean, we've seen inflation start to bottom out. If you think back to 2 years ago, we had inflation basically around 0%, and most of that was the decline in energy prices. Now we've seen, energy prices over the last year have risen about 75%. We're around $50 a barrel in terms of WTI. And that has pushed, just this week, the CPI data came out, and we pushed above the 2% mark that we kind of think as sort of the underlying trend growth rate of inflation, that the Federal Reserve's trying to get to. Now, they actually target, of course, a different price index that's chained and runs a little bit lower than the CPI, but in terms of the headline, it should also continue to trend up, and we expect to sort of run right around that 2% mark. In terms of energy prices, I think we've had a rebalancing in supply and demand over the last year. The cuts that OPEC has announced, and in fact Saudi Arabia has been cutting production to try to shore up the oil price. I mean, that will be offset in part, again, as it has been, by production in North America, some of which should come back online. The lower price environment in the United States has made U.S. production just that much more productive. But at the same, I think, just given sort of ongoing global growth, the supply and demand, we should see gradual increases. We have about 3 to 5% increase in oil prices over the next year. I'd expect to see about the same 3 to 5% increase in gasoline and in fuel, home heating fuel, sort of over the next 2 years. So that of course increase in inflation is 1/2 of the Federal Reserve's mandate. As mentioned, they try to get inflation to 2%. If you look back when they raised rates for only the second time in a decade, in December, they spoke of the improvement in actual inflation and their expectation that inflation should continue to move higher. They also expressed confidence in the outlook for the labor market. Where there was a little bit more uncertainty, of course, was around the implications of fiscal policy, and their minutes of their meeting really emphasized that you saw sort of a lot of uncertainty about how they will react if there are major changes to fiscal policy. But one thing they did do in that meeting, they put out along every 3 months when they put out their interest rate announcement, they also put out projections for where they anticipate rates to go. Last year when I was speaking to you, when they raised rates in December, they anticipated 4 rate hikes. Well, they only managed to get 1 in 2016. But this time they had moved actually from an expectation of 2 hikes back to 3 hikes over the next year. And I would guess that we will get more in the direction of more than 1 rate hike this year, just given, again, where the economy is and where some of the other upside risks to the economic outlook are in terms of fiscal policy. But nonetheless, I mean, you're still looking at a rate of increases for short-term interest rates that are well below what they have been historically. Even if the Fed raises rates twice this year, that still will count among the slowest rate of increases we've seen, and probably going back to a level that is not what it was prior to the recession. Again, I think reflecting some of those trends I was speaking about earlier, just in terms of it's harder to come by economic growth the way we've seen historically, and that's the kind of thing that keeps permanent downward pressure on the level of interest rates. So, we'll have the inauguration on Friday. This is just sort of looking at the economy that a little bit of, Trump inherits a solid economy, is a look back at sort of what we've seen over the last 8 years. We are into the 8th year of economic expansion. This will be, it's already the third longest economic expansion that has happened in the United States before, a turn in the business cycle. The longest went from the early 1990s to the early 2000s, and that was 10 years. So if we can last to 2019, this would be the longest economic expansion on record. The data goes back to the mid-1800s. But nonetheless, we've seen growth be a bit slower, obviously, than it's been historically. Have some theories about why that is. We expect to see a rebound over the next year, but not sort of breaking out into a range that, maybe we'd like to see 3 to 4%. Now, our forecast has not anticipated any major changes in fiscal policy, in part because there is little detail about, the magnitude, the scope, the timing of when those will come in. So if we were to get that, I think that presents some upside to the outlook. I meant to mention it earlier, but the other side of sort of the growth environment, and something that's important to sort of the underlying potential growth rate of the economy, you have your demographic side, but you also have your productivity side. And there is some debate about sort of whether we have seen a permanent slowdown in the rate of productivity and innovation growth. Among economists, you have techno-optimists who think that we will continue to see this trend toward automation, and that will only accelerate and really raise the level of productivity to break us into a higher growth rate. You have others who think that we've seen a real change, a fundamental change in the nature of innovation, that it's limited to sort of information technology, and we won't get that kind of rebound. I mention it because it's important from the point of view of some of the policies that could be enacted to raise the growth potential of the economy. Obviously, on the demographic side, you have the potential to change immigration. That seems to be a political non-starter. But on the other side, on the innovation side, and on the productivity side, changes that are made to make investment more appealing, to lower tax rates on investment, I think do have some potential to at least raise the rate of productivity growth. And that kind of, I think, sort of segues well into the discussion of some of the policies that we may see over the next few years. Even before that, though, we do expect to see a bit of an improvement in the rate of productivity growth. So if you look at what happened over the last year, the economy grew by 1.6% in 2016 on an annual average basis. That was disappointing. That was a bit slower than we've seen over the previous years. The major reason was a decline in investment spending. Now, a lot of that came in the oil sector, but you also saw spending on non-energy decline through much of the year. I think over the next year, that will be the main source of acceleration. Why we expect that to happen? Well, one, we have evidence that it's already happening into the end part of the year. If you ask businesses about their investment intentions, they've pointed to much higher expectations for investment in a way that has typically led to higher investment. We'll expect we'll get that as soon as when the data for the fourth quarter comes in. But also over the year after that, we've seen improvements in confidence. We've seen in business confidence. We've seen that manufacturing indexes have pointed to an acceleration in activity. We've seen sort of where over the course of 2016 there was potentially a bit of an inventory overhang. Much of that has been worked off, and that should set the stage again for a bit of an improvement in investment. Now, of course, that's before we sort of get any potential changes in policy. And I think where the upside comes from is if we do see some changes, especially to corporate tax rates. On the other side, where there could be some disappointment is if we don't get changes in policy, or that those expectations are disappointed, because again, even without building in the policies itself, the turn in expectations is positive. If that turns the other way, obviously that's a negative influence on investment. So in terms of fiscal policy, I mean, here's kind of the core issue that we're facing now in terms of the outlook, and as I said, sort of widening the bands on the outlook. I think there are some things that we can say with some confidence that there will be some form of tax reform. I think that was, in fact, likely regardless of who won the presidency. There had been a push for that. It should be a little bit easier with having, a Congress that's Republican and a president that's Republican. It's still not a piece of cake, of course, because Congress can pass things in reconciliation, but they have to be revenue neutral. If you want to do things that lower the tax burden, but don't offset it with spending cuts, that's very difficult to do without sort of having the 60 votes in the Senate. There are 52 Republican senators. They need 51 to pass, so you need all of them to agree. But nonetheless, I think even among Democrats there is some realization that the U.S. corporate income tax is uncompetitive with much of the rest of the world. The trend around the world has been to lower corporate income tax rates. Tax codes around the world have moved away from taxing investment, and the U.S. is yet to catch up to that. So I think that will likely happen. Now the question is sort of what is the rate they end up at? There's some talk. Trump had campaigned on 15%. The Republican House plan was for 20%. And sort of how they do the reform. I mean, the mantra is always lower the rate, broaden the base, get rid of some of the tax deductions that are out there for specific industries, for interest costs, and offset that with a lower rate across the board. The talk what's interesting in the House Republican plan is this move to what's called a destination-based cash flow tax with a border adjustment. That would attempt to move the corporate tax code to only tax really domestic earnings and domestic spending. So it would allow for a deduction. So it would only tax things that are consumed abroad. Consumed domestically. If you exported, you would get that wouldn't be counted as revenues. And on the import side, you would be taxed on your imports, whereas you can deduct costs in terms of wages and salaries. So that is, there's been a lot of talk about that. You heard President Trump say he didn't like it. He thought it was too complicated. The benefit of it is it removes sort of any of the foreign component to the tax code and moves the tax code in a way that is most other countries have that have value-added taxes. It's actually even arguably more than a value-added tax, because value-added taxes don't deduct earnings or payroll from so it's really taxing just cash flow. Nonetheless, you can make an argument that it is very similar to a VAT in other countries. You can have some combination of a reduction in personal income tax rates that would basically make it equivalent to a VAT. It's uncertain whether that will hold muster with the WTO. So there is the potential that you could see some countervailing measures there, because under WTO rules you can VATs are okay because they are deemed indirect taxes and they are border adjusted. But if you income taxes and the deduction for payrolls in particular makes it a deduction for a direct tax. So remains to be seen what will happen there. But if there is that kind of reform in that direction, the potential is that it would increase the value of the U.S. dollar. Of course, if exports are cheaper for foreigners to buy, there's higher demand for U.S. exports, that usually with floating exchange rates will put upward pressure on the dollar and kind of offset much of the gains in competitiveness. To the extent that the dollar doesn't rise and imports are taxed, that puts upward pressure of course, on consumer prices in a way that has implications for consumer spending. And of course, there will be an impact by industry. If you're an industry that's importing a lot, for example, energy, if you're a refiner importing a lot of foreign oil, you're going to pay a lot more on oil. Some of that will likely go through to higher oil prices. If you're a retailer importing a lot, that will eventually have to be passed on. Nonetheless, I think, again, I don't know how that is going to go down, whether there will be that form of tax reform, but I think there will be something that reduces the corporate tax rate, and probably does it in a way that decreases some of the tax incentives for debt, and also makes capital investment. The other talk of the reform is to fully allow businesses to fully deduct capital investment, not having to depreciate it over several years. So that kind of will make it incentivize bigger investments in the near term, longer lived investments that you can reduce your tax burden immediately. On the personal side, obviously we've heard, the Republican plan has long been to lower rates and broaden the base, lower the number of brackets to 3. Again, I think the big constraint is that will reduce revenues by a fair amount, in a way that even some hawkish, deficit hawks, Republican deficit hawks, will have, I think, some issues with. But if you think of sort of the impact of sort of the overall, what could be done in terms of tax reductions and infrastructure spending, the analysis that's done, sort of the consensus is that you get your biggest bang for your buck in the very near term with infrastructure spending. And of course, the Trump plan was for $1 trillion in infrastructure spending. Again, very little detail. It seems that wasn't $1 trillion in additional government spending, but was sort of what would be eventually leveraged up. There would be, sort of an initial capital investment of something like $150 billion, and then tax credits that allowed that to be leveraged up by the private sector. But infrastructure spending is also something that has the longest lags in terms of by the time it's passed into a bill, and by the time the money, the shovels go in the ground. I think it was Obama, but maybe someone else, who said there's really no such thing as a shovel-ready project. So by the time you sort of do the analysis and get the shovels in the ground, you're already into 2018 and maybe further on. And then the question is, are you actually having any near-term impact, or are you just competing with scarce resources in the private sector? So those are, I think, some of the issues around the potential for fiscal stimulus. Again, I think you want to really break it down into the near term, the potential. So in the near term, if you think about what tax cuts could do, to the extent that they're spent in the economy right away, they boost economic demand. To the extent that infrastructure employs people that wouldn't otherwise be employed, it raises spending. But I think the bigger promise of some of these things, even if they're more revenue neutral, is to reform the tax code in a way that increases the long-term kind of growth potential of the economy. That's not the kind of thing that you would expect to see have a huge upward pressure on inflation or on interest rates. It's a lot less sexy, but that's really, I think, where the best hope for sort of long-term growth is. Now, this is important because, again, and I sort of alluded to it, if you're operating with little capacity in your economy, and you inject a bunch of additional fiscal spending or tax cuts and spending, you're just competing with resources that are employed. This is a debate that we heard even on the campaign trail, sort of, well, we can't trust the underlying unemployment rate. There are a lot of people that are still unemployed or underemployed, looking for work, just not looking for work because they're discouraged. There probably is some truth to that. And if you look at other measures, so one way to sort of get around that issue is just to look at the number of employed people relative to the population. If you limit that to sort of people 25 to 54, you get people who should be, you think, participating in the labor market. In fact, in those age groups, they typically do at rates over 80%. And you do see that since the recession, the level, that ratio, is still about 2 percentage points below where it was prior to the recession. Now, again, it's hard to say that it should go back to where it was prior to the recession because some of the trends, especially for males, have been happening for the last 50 years, where we've seen a diminishing level of participation. And it's hard to say that that is the right level. But nonetheless, we have seen continued improvement in this metric. And if we continue to create jobs at the rate we have been over the last year, sort of 150,000 to 200,000 jobs a month, this will go back in the next year and a half to where it was prior to the recession. So that brings me back to that point about infrastructure spending. If your infrastructure spending isn't going to hit the economy until 2018, well, by then the economy actually is pretty close to full employment, and you are just going to be competing with resources that would be employed otherwise. This is important, though, in terms of sort of the mainstay of economic growth, which is consumer spending, and we have seen that show up in faster wage growth. Wage growth, on average, accelerated to 2.9% in December. We like to look at this median wage metric because it sort of looks at the wage growth of the median employed worker, someone who's employed a year ago. That takes out some of the aging bias that actually puts downward pressure on average wages. If you think about people retiring at their peak earning years and are replaced with people, who look like me, they don't earn nearly as much, and that puts a bit of downward pressure on average wage growth. Median wages are growing by 4% year on year. So clearly, we are seeing, I think, what can only be called a meaningful improvement in the labor market. So that brings me to that point. If you look at the level of unemployment across the country, it's 4.7%. It rose from 4.6%. It should, we don't think, get much lower. In fact, what we will see from here is more people coming back into the labor force that's driving those ongoing jobs growth rather than pushing the unemployment rate much further. Now, in Maine and in Portland, the unemployment rate is even lower. It's always been lower than we've seen across the country. It dipped to I think it was 3.4% before moving up to 4.1%. That is probably a bit of a statistical anomaly, and you see as these things are revised, I think you'll see a smoother path of unemployment in both the state and in the city. But still, I think we're pretty close to what has to be considered full employment, especially in the state of Maine. So what's been limiting the pace of job growth is certainly not the fact that we've have anything in terms of cyclical factors. It's more due to longer-term structural factors, and particularly the demographics. I think you're all aware of this, but this just breaks down sort of the growth in the population by age group, and the majority of the population growth is in people above the age of 65. You see, if past trends continue, younger people a decline in the rate of younger people who are entering the labor force, and of course that creates the big challenge, the same challenge that exists in, as I said, advanced economies all over the world of having very, very limited, potentially zero labor force growth unless you can draw more people into the state. Just on a construction, didn't mean to close on a kind of a negative point. I think there still is, even with this, with the rate of growth in the underlying economy, which should continue at about the 1% rate, we should still have household formations that continue to support an improvement in underlying construction activity. If you look at headship rates, they tend to rise as people age. That tends to lead to an increase in construction. You also, I think, have the potential for second homes and vacation homes continuing to push up construction in Maine, and that should allow construction activity to continue to rise. Okay, so that does it for my presentation. I meant to leave time for questions, and I went a little bit over. Do we have time for maybe one question or two questions, I suppose? just because that's my favorite part of the event, and I didn't give myself any time for it. I apologize. No, I can't see if there's anything. Yes, sure.
Historically, isn't GDP growth 3%?
Yeah, that's a great question. So the question was, historically, hasn't GDP growth been 3%? That's exactly right. That was that very first slide that I was getting to that was saying sort of, it had been sort of slowing, but if you look at sort of the century from 1900 to 2000, the average growth in the American economy was 3%. Mind you, that 3% growth came with labor force growth that through much of that period was about 2%. We now have labor force growth that is about 0.5%. And in Maine, it's 0%.
Well, private investment as part of that equation.
Yep.
And what we're seeing over the last 3 months.
Yep.
Why wouldn't you, in your forecast for 17, 18, why wouldn't the private investment be increased what you see in like 2014, 15?
Sure.
And why wouldn't you be showing a 3 to 4% increase for 17, 18?
Well, yeah, that's a good. I mean, really, the question is around the magnitude of the increase in investment that you would need to get, and to realistically, if you saw investment double or triple, you still aren't getting to a 3 to 4% rate of economic growth. It's just impossible to get there.
The tax benefits are there, right?
Oh, I have no doubt that is up. I mean, so the argument is that if we do have, I mean, I hope this came out, that pro-growth tax policy will raise the rate of investment and potentially raise the rate of economic growth. The question is of magnitude and what's realistic. And what's realistic in terms of getting there. And I would just argue that probably you can get to maybe 2.5% growth. It's very difficult given the demographics to get much higher than that.
And my follow-up question, on your unemployment analysis, you said you can't get much lower than that.
Yeah.
Isn't it true, though, that some of the unemployment isn't really part of the equation?
Well, that was, I mean, exactly what I talked about. If we create 150 to 200,000 jobs, that will be eliminated. All the marginal slack in the labor market, even outside of the unemployed, will be eaten up in the next 2 years.
There's people that are not working that are part of that equation.
But not if you look at the employment to population. Let's talk after, because I think we can continue this argument. But thank you very much.